Okay. 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 Default. Okay. Okay. Okay, so you see that perfectly now?
Yes.
Mhm.
Perfect. Okay, thank you. Okay. That's a heck of a library you have at home, Hemel.
Yeah, right.
Very impressive, very impressive.
I'm a scholar.
You are a scholar. Very impressive. Okay. For everybody who's just joined, we're going to start in about a minute. We shared the screen on, some of the basic bullet points that we're going to talk about. So just give us about a minute and then we'll get started. And as people join in, they can listen in. Yeah. Right. Robot. Okay. Okay. It's the top of the hour. Well, welcome everybody. We are happy to have you participate today, wherever you're located in the country. We've got people joining us from actually all over the country, some different time zones. So we tried to make this at a time that was accessible and convenient for everyone, whether on the East Coast, Midwest, or out here in the Southern California. So my name is Todd Wool. I am one of the founding members of the Capital Markets Lenders Association, who's putting on this event today. And I'm honored to have a couple of our friends and speakers as well. And our topic today is essentially what makes a successful workout. I'd like to introduce first, I guess I'll start with Hemel Master. Hemel is a longstanding lawyer at the law firm of Fransdell, Robbins, Bloom, and Chateau in Los Angeles. Hemel, do you want to just do a quick background on who you are and what you specialize in?
Yeah, absolutely. Hi, thanks for having me today, Todd. Looking forward to this. And as Todd said, Hemel Master, I'm the managing partner of Franzel, Robbins, Bloom, and Chateau. We're about a 32 attorney law firm, headquartered in Los Angeles, office up in Central California. I specialize in, we're a finance law firm. We specialize in representing lenders and creditors all over the country in various matters, including transactional work, bankruptcy, litigation, workouts. I, in particular, am mostly on the transactional side and do loan workouts for banks, special servicers, private equity funds, debt funds. That's a little bit about me and what I do.
Okay, well, thank you, Hemel. Now we'll go to obviously the far more attractive speaker in our group today, Selena. Hello, Selena Perlskin with Beacon Default Services in Southern California. Selena, would you like to introduce yourself?
Yes, thank you. And thank you, Todd, for inviting me. I'm Selena Perelskin with Beacon Default Management. I am the founder and CEO of the company, and we handle non-judicial foreclosures in the Western states, 9 of them. And I've been doing this or similar to this for, let's just leave it at over 30 years. We don't need to add any more years to that.
Okay, well, I'll round it out. For those of you who know me, the introduction is probably not needed, but my name is Todd Wool. I'm one of the partners at Braun International and Premier Estates International Real Estate. We work throughout the U.S., Caribbean, Mexico, and England. We've got about 3,800 partners and affiliates across the country. And in most of the major markets that we serve. I am based in California, but work throughout the country with with all types of lenders, whether they're servicers or banks, from money center down to community banks, as well in the bankruptcy and receivership world um, for valuation, brokerage, and auction of real estate and business assets. And I'm pleased to have our speakers today, and we're going to talk about a topic that's obviously in vogue, I like to say, and is changing every day. I think what we're seeing, all of us, and we're going to talk about it today, is what we're seeing and what we're experiencing in all of our businesses. And we tried to put together a quick bullet point on some of the topics we're going to hit. This is going to be very free flowing. If anybody wants to ask a question, you can either unmute yourself or submit in the chat room that is open. So I'm going to, as you can see, again, the focus is working out loans, whatever type of loan it might be. It might be real estate, it might be a C&I, it could be any type of security interest. So I'm going to start with, I guess we'll start at the bottom and then move up to the top on at least on my camera. So Hemel, what strategies are working with lenders to accomplish successful workout? And Selena, you can chime in.
Sure. Yeah. So I think what's important in that question is kind of define what constitutes a successful workout, which, as Todd mentioned, things seem to be changing on a daily basis at this point. From my clients' perspective, which are predominantly lenders, a successful workout is, at this stage in the cycle, is getting out of whatever loan they're in with as little damage as possible, taking as little of a hit as possible. From that perspective, I think what's working is it's not common. There's no common themes. It depends on the asset class. If it's a C&I loan, my experience has been speed really matters. Getting a handle on the inventory or the collateral as quickly as possible. Foreclosing through a UCC sale or through a receivership. Getting in there, opening up the books, and really taking account of what's out there, getting in front of account debtors. Those things are paramount, I think, in C&I workouts right now. Speed is really your friend. In the real estate world, it's a little different, because obviously everybody knows about the challenges in the office world, and that it's a game of hot potato at this point. Borrowers are calling their lenders and saying, well, we don't want this asset, you take it. And the lenders are saying, well, we don't want it, do something with it. And so in those scenarios, receiverships seem to be the flavor du jour, and we're getting receivers appointed over massive office buildings in some cases, where the receiver is just trying to get a handle on the leasing and keep tenants in place, give them TI money, kind of stabilize as much as possible, and then try to figure out a strategy. And on the other hand, we've been involved in some real estate workouts where there's cannabis type of properties, cannabis operations or warehouses where cannabis was grown, and that's another challenging area right now, because it seems as if, at least out here in California, the cannabis market has been flooded, and the demand has therefore gone way down. And so these nice, beautiful warehouses that were built for cannabis, distribution or manufacturing, really can't be used for a whole lot of other uses. And unfortunately, now that the market seems to have dried up, lenders and borrowers are kind of left wondering what they can do with them, and repurposing them can cost a tremendous amount of money that nobody wants to spend, or nobody has the ability to spend. And so that's a different kind of scenario. And in those cases, those those matters seem to be stagnating because nobody's quite sure what to do at this point. Um,
So let's have Selena. Selena, what would you like
yep,
to
go ahead,
add?
Selena.
Well, what I thought about talking about last week when I looked at the bullet points changed entirely. Yesterday, I had 4 sales, and they're very interesting because I've not seen this happen. I had a private REIT, or a REIT, I shouldn't say private, as the first lien holder, and I had BMO as the second. And the REIT was extremely interested in the hopes that the properties would revert back to them. It was broken construction, and it was their intent to complete it, take them a few years, and then turn around and sell it. And BMO wanted to work with the REIT to put additional funding in so they could stay in the deal in a participatory capacity. 3 of the deals reverted back to the REIT. They were very happy. And on the 4th deal, it sold to a third-party bidder at $10,000 less than the payoff amount. They were very surprised. The third-party bidder is very happy. And it wasn't a small deal. They came to the courthouse steps and tendered $17,850,000. We do not see sales at the courthouse steps. In 15 years, I've seen one. The highest amount was $6 million, and it's a long story, but we ended up refunding the third-party bidder their money. So it didn't go through, and that was because of a last-minute bankruptcy. So this is the first deal in 15 years that this type of third-party bidder with that type of money actually showed up and bought it on the courthouse steps, and they're elated. And the lender, the REIT, is disappointed. But either way, the REIT is, talk about a successful workout, which I never really think they are if they land on my desk. I mean, you get through it, the lender gets through it, but usually there's a discount in there, or some, fees are dropped, and typically they're not always made whole. So talk about dynamic and things changing. The third-party bidder wanted to make sure that it didn't revert back, that it didn't get sold, that it didn't have to work with the broker. They were confident in the property, and that's what happened yesterday.
So from our perspective, I mean, against just addressing, what are the strategies that are working for lenders, since we're in some cases either the front end or the tail wagging the dog. Our biggest issue is valuation. And yes, to Hemmel's point, it depends on the asset class, whether it's real estate or C&I. Valuation, of course, or appraisal is always the kind of the first rung. And we're finding that a lot of our clients don't understand how to use the appraisal if it is for litigation or for workout. So there's lots more flexibility, and the types of valuations that could be requested, or the values provided, be it a forced liquidation value, an orderly liquidation value, fair market value. There's distinct differences. Additionally, with as-is or hypothetical valuations, if we're speaking about real estate. So we're educating our clients on the appraisal valuation component first, to try to give them what they think they're going to be getting when they see that price on that piece of paper that they think the assets are worth. I think that's the number one start issue for us with clients on the actual strategies of sale. Candidly, because we broker an auction, I wouldn't say to you, and for those of you familiar with auctions, some may think well of the process, some might not. I would tell you, with certain types of real estate, auctions are performing, believe it or not, better than a brokered sale. That might be high-end residential, which we're doing a lot of in our Premier Estates group. Screwed up retail, screwed up office. Auctions are a very quick process, but they also create urgency and frenzy. Brokered sales, as you all know, are just very tight. Very well. I like to separate them. One is a marathon and one is a sprint. The marathon is the brokered sale, and sprint is an auction. So strategically, I wouldn't say one process is better than the other. It's a question of what the strategy with the client is trying to achieve. So we tailor it based upon their needs and candidly where we think the market is going to be, what the buyers are willing to write the check for, because in the end, it's up to the buyers. I'm sure Selena and Hema would agree on that point. Let's go on to the next question. I'm going to start with you, Selena. Do borrowers think that because of the dynamics of the market, they can take advantage and accomplish a workout with no new money? You want to start with that, Selena?
I think they can, but I'm not seeing it happen. We specialize in CMBS. Although let me also say CMBS has been slow and the banks are more of the business, but we do. And I don't know any of the CMBS, even if they've got a great sponsor, and that has a lot to do with it. They want money. They want new money in the deal. So, but I also don't get the firsthand look that Himmel gets because he's negotiating the documents. I sort of get the no, we're going to postpone, this is being done, or that. So I'm not getting a firsthand look, but seems like they want money, and the borrowers think they don't want to give or shouldn't have to.
Fair enough, Hemel.
Yeah, I think it's a mixed bag. I think borrowers typically right now are coming in with the perception that they do have an advantage. They obviously see the headline news. Banks are, the regulations are, regulators are clamping down on banks. Banks are suffering from lack of liquidity. So a lot of borrowers are coming to banks in particular and saying, hey, I can find a way to get you some deposits. What are you going to do for me, kind of thing? Help me work out this loan. That seems to be a common entree at this point. Whether it goes anywhere or not is a different story, because ultimately the dynamics of the deal in particular take over. And contrary to a lot of borrowers' popular belief, the regulators still want the banks to work out the loans. They don't want them to necessarily stand by and let them go get worse. And banks do have capital risks and issues right now, and they do have liquidity risks and issues. But at the end of the day, they're all looking to work them out in most cases as quickly as possible, rather than carrying them on their books and putting aside long loss reserves and so forth. So I think there are a lot of borrowers that have that perception, but it's not necessarily always the case that they do have a true advantage, so to speak.
Well, I would say from our perspective, again, depending on where we're brought in the process, when it comes to C&I, we don't see borrowers taking advantage or able to take advantage of the situation. Not at all. In most cases, we're seeing either the secured running an Article 9 sale or just some sort of liquidation because the assets have to be dealt with quickly because of occupancy or because of theft or whatever. And the real estate side, we are seeing, being on the tail wagging the dog side, I would like to say, be it the broker or the auction specialist, we're seeing a lot of delay, and we're seeing a lot of lenders trying to work out some deal with the borrower. I think candidly, if I had to give you percentages right now, it's probably 50-50, just at the top of my head, that are being renegotiated with the borrower versus the borrower is kicked out and the lender moves on. I think candidly, to everybody's point, it's in real estate, it's the asset class, the bad retail, the dark the partially dark office. Everybody is trying to just figure a way not to take it in, candidly, not to appoint a receiver, not to foreclose, and just hope that something's going to get better tomorrow. and for us, it's a question of where is the asset located? Industrial building in a market where thieves are breaking in and stealing the copper and the air conditioning systems and the wiring and destroying a building in a matter of 5, 6, 7 hours. It's all relative to the market and the asset. So we're just trying to keep everybody focused on, candidly, the risks from our end that we see. Next question. Are there common challenges on every loan other than the obvious, no market liquidity, high interest rates, and valuation? I guess, Hemel, do you want to start with that?
I wouldn't say there's common challenges on every loan. I mean, the ones you mentioned obviously are present in almost every loan. I'd say the biggest challenge, especially when it comes to real estate secured loans, is valuation. I'll just give a story that a case I'm dealing with right now, where it's a syndicated loan backed by an office building, a large office building. And, my client, who's the agent bank, has marked down the loan. I think the loan amount was about $58 million. My client has recognized that the building is worth far less than that, and they've marked down the loan. From an evaluation perspective, at least, they think it's worth somewhere in the 40s, whereas the other co-lender on the deal believes it's worth somewhere in the 60s. And obviously that leads to a number of disagreements as to strategy, as far as the workout's concerned, because the loan is in default and there are challenges with vacancy. And so to me, that's the most common issue right now is valuation. The old saying goes, nobody wants to catch a falling knife. Nobody knows where things are going. Some lenders believe the office market will recover in 3, 4, 5 years. Others believe it's never going to come back, and therefore they want to cut their losses while they can. And so I think that's, from my perspective at least, that's the biggest challenge on every loan, especially a real estate secured loan, is where is that valuation? An appraisal is great, obviously, but it's, it can change. The value can change literally daily or weekly, and that's why it's so hard to value things right now.
Selena, any thoughts on your end on common challenges?
I don't want to categorize it as a common challenge, but I can tell you 2 things that we're seeing that we didn't see in the last downturn that seem to be a theme. First of all, we're seeing sponsors just give the property back. We call it a friendly foreclosure. We didn't see that last time. It's more and more common. The other thing we're seeing, and this is because we're doing more bank work, as you know, in a CMBS loan, bankruptcy is not frequent because there's a springing guarantee. But with a commercial loan, we're seeing one bankruptcy after another. Last recession, we saw 2 bankruptcies. I have 19 at the moment going on. So not common, but certainly a theme. Give it back, or BK, is in the mix.
So from our perspective, I'm going to address the last word in that bullet point, which is valuation. And to Hemel's point, we'll give you an example. We just got done appraising an office building in the financial district of San Francisco, which for any of or all of you viewers know, the San Francisco office market and retail market in the city is beyond stressed for many reasons. I don't think we need to get into that at this moment, but the client purchased the building at the end of 2015 for about $138 million. We just got done appraising the building at about $58 million. And that was a fair market value that we estimated the time to sell would be 12 to 16 months. And candidly, that was not an easy appraisal to arrive at. Because of the lack of the data points, the building is about 35% vacant. They've got homeless encamped in the retail space at the street level. City of San Francisco is doing nothing to get rid of them. tenants aren't going into the city, all the things that you hear and read on the news or in the whatever are affecting this property. And the lenders, the group of lenders said, well, we're not selling it for that. We're not selling it anywhere near that. So I suggested we appoint a receiver. And they said, well, we're not going to spend the money. And I think you can imagine where the conversation goes from there. And I said to him, well, you can do an article, you can do a foreclosure sale, but you're not credit bidding in, you don't want the building. So now what? And the answers to my question have yet to be answered. So from a valuation standpoint, kind of going back to what I said a few minutes ago, the type of appraisal, the type of value you ask for is going to clearly help the parties understand where the market is today. And I guess to Celine and Hemmel's point, it changes it changes every moment, every day, every week. So when you ask an appraiser who will hypothetically not hypothetically, will estimate that the sale process may take 12 to 18 months, well, we all know there isn't a property you're going to keep on the market for 12 months at the same price and assume it's going to sell 12 months from now for the same price you listed it at 12 months ago. There would always have to be a price reduction. You have to keep up with the market. So keeping up with the appraisal approach and the type of valuation is, again, the same thing as I said before. The most common challenge that we're tasked with, be it as an appraisal firm, but then taking that appraisal and using it for some sort of sale and how it correlates to really where the market is. Because a lot of the appraisals we're given aren't worth the paper they're printed on, candidly. Not because they're bad appraisal groups or appraisers, it's just the data points aren't there in many cases. That's what we're seeing.
Well, and I think, Todd, the other challenge is the lack of deals in the market, probably
Yes.
over the last 6-8 months, have made it even more difficult for an appraiser to find where the real true market value is in a lot of cases, right? Because there's just not a lot of deal flow.
Well, again, depending on the asset class, right, and where it is, Hemel, you're 100% correct. And I know Selena's seeing the same thing. I really think that when it comes to, liquidity in a marketplace, I wasn't going to bring it up here, but it's just at the top of my mind. Candidly, for those of you who trade in California, who work in California, what we're seeing is our biggest impediment is insurance, or the lack thereof. The mainline carriers have exited because of the insurance commissioner and the issues that are surrounding that we're told won't be resolved for another year and a half. So we're seeing Cal Fund as the solution, which is the only solution in many of the deals we're working on. And just to get a quote is 6 weeks. So what we're seeing an impact is even when we go under contract, interestingly enough, and then the borrower looks to go get insurance.
Get insurance.
The insurance is not readily available, or the insurance cost is quadruple or 6 or 8 times the original borrower or seller's cost. And that then is impacting, it's a retrade in escrow on the sale price of the property. So we're selling 3 properties that are in red fire zones right now. And I can't tell you if any of the 3 are going to close in the next 3 months. And none of the sellers, all sophisticated clients, didn't even consider the insurance issue when we went to market. So that's affecting valuation. To your point, Hemel, it's affecting, it's affecting what a property will trade for. And it's just not on the people's radar. Anyway, let's move on to the next bullet point. For you, Selena, we'll start with you. What should lenders consider when they do a deep dive into an appraisal? Any thoughts on that?
No, the only thought is that I hear from my side, the feedback, it's never what they expect it to be, ever. So there's the one thing I can tell you that I hear, you know, I'm not involved in those underwriting and the memos that go back and forth, but it's always a surprise. And that's the only piece of it I see, or, you know, it comes in and they realize that there's no way they're going to be able to work it out. And the loan may have been delinquent for 6 or 8 months. And now all of a sudden I need to stay late and prepare papers for a non-judicial foreclosure because everything they've talked about, it cannot work. And now it's a rush for me to start the process. So that's all I can speak to as to the appraisal evaluation.
Fair enough. Hemel, any thoughts? Comments?
I think the, you know, you have it on here, the scope of the valuation is really important. What the lender is looking for from the appraisal. You know, because things are so fast moving, I think it's important to get various types of valuations. So, you know, an as-is valuation, as stabilized, a liquidation scenario. I have one matter right now where, you know, an apartment building in San Francisco, and the borrower came to my client and said, "Look, we can't make it work anymore. Tell us what you want to do with the building. We can't afford the debt service." And, you know, bank said, "Well, we don't know. Let's get an appraisal." Get an appraisal. Appraisal is not great. And then the borrower says, "Well, here's another idea. We can convert all of the apartment units into tenants in common and sell them off as tenant in common units." That's common in San Francisco.
Yeah.
I talk to the bank and I say, "Guys, do you have a tenant in common valuation?" "Well, what's that?" "No, we don't." You know, and so, you know, now we're going back to the drawing board and trying to get an appraisal as a tenant in common proper project. So I think, you know, going in what the possible scenarios are going to be is important when you get an appraisal, because now going back to the drawing board, we're going to have to get whole new valuations for all of these. Because if they go convert the building into a tenant in common building, it's a whole different ballgame than what it was as an apartment building. So I think that's really important on the front end, when they get engaged their appraisers and tell them what they're looking for.
I can give you an example of, and Todd, this won't surprise you, or Himmel, or maybe our participants. Maybe I was the only one surprised. It was an office building in San Francisco. The UPB was 60 million. The appraisal came in at 10.
Yeah.
That's, you know, what do you do with that?
Yeah. Well, you put it under a rock or maybe under the desk, or it's a door jamb holder and everybody forgets about it. I don't know. You know, for us, it's very common. You know, again, talking about appraisals, and to Hemmel's point, I think a lot of it, I mean, candidly, I think the choice of the appraisal firm that you engage is very important in this round of, if you're dealing with a workout, if it's in special assets, if it's BK, whatever it is. Candidly, I would engage an appraisal firm that actually has asset sale expertise in that asset class, because their insights will have a very different approach in valuation than if it's just, you know, the appraisal firm of you know, Smith and Smith. I think there's distinct differences. And I'm not saying that because that's what we do. I'm really saying it because I'm seeing distinct differences in the appraisals. I think, as I said, I have a dozen appraisals on my desk from firms that I would consider very reputable, and they're not worth the paper they're written on when it comes to sale process, a sale value, I should say. So, you know, but also for all of you, understanding what you can ask of the appraisal firm. The appraisal firm should ask you a litany of questions regarding what you're trying to achieve, not from a price standpoint, because that's not kosher, but from just a process standpoint, timing standpoint. As Heimel said, the hypotheticals. There are, of course, lots of hypotheticals that can be provided. We have a valuation appraisal that we're doing that there will be a negative value. So the real estate is dark. The value of the property is a demolition value. Well, it's demolition value of the property that is a negative value on the land because the building will need to be demolished to arrive at a land value that then can be sold or potentially sold. So the lender wants to know what that land value is. Well, you actually have a negative value because you've got the cost of demolition. So we're estimating that. I guess another approach would be fair rental value, as Hemel mentioned, right? We're doing a lot of fair rental value evaluations, whether they're full appraisals or back of the napkin. Back of the napkin opinions as to where the rental value is, and then hypothetically, how would that stabilize the asset if you were to get those hypothetical rents, right? Because it's interesting. I kind of want to take. I am seeing a lot of leasing, a lot of opinions coming back from the tenant rep or the leasing companies on a specific asset, be it office or retail. I think I'm really talking about mostly. And their estimated rental rates, they're unrealistic. They're way too high. They're hoping, they're praying, they're not realistic in trying to stabilize the building quickly and get tenants in there and not write big TI checks. So coming in with a 50% less fair rental value, well, of course, would affect the hypothetical stabilized value. So again, these are all things that need to be discussed with your appraisal firm before you task them with just saying we need an appraisal. I think that's probably the best advice I could give here.
Yeah, the other thing I would mention, Todd, to your point is because, and to Selena's point as well, because bankruptcies seem to be ticking up, what I always advise clients when they are going to order an appraisal in anticipation of litigation or a workout is make sure the appraiser you're engaging has experience testifying in court and defending their deposition.
Yes.
It's not something that's often thought of by the folks that order appraisals, inside of banks or as a servicer, but it's very important, and it's becoming even more important at this stage in the cycle.
Yeah, I mean, I would say to you, we have a very big team of appraisers, and half of them I wouldn't put on a stand for all the tea in China, Hemel.
Yeah.
They just don't have that. I mean, they're brilliant people, but they can't take that kind of pressure, or they don't know how to deal with cross-examination, whatever it is. But then, many of our appraisers are very, very vetted in the court situation. So that's really a good point. I wouldn't have thought of that. Next question for you, Selena. If a successful workout is not accomplished, what remedies are lenders utilizing? Is this different from the last cycle, Selena? Foreclosures, note sales, auctions, receivership sales. So I'll let you start on this one.
We will see the lenders start the non-judicial foreclosure in most of the Western states. It takes about 4 months. That starts the clock ticking, but we also see them looking for a note sale, looking to see if they're even going to entertain an REO, and we're finding a lot of note sales. They just don't want to take the chance. They don't want to own the property. So the foreclosure's ticking along, and it's with somebody where they're trying to sell the note. I didn't see as much of that last downturn as we do now, but we'll also have more bank work. And the banks, I don't think they're going to set up these huge REO departments like they did last time. I think that was very painful. So that's what we're seeing.
Hemel?
Yeah, I tend to agree with Selena. I mean, I see a lot of foreclosures being started, not necessarily completed. And again, in larger loans, I'm seeing more receiverships being started. Receivership sales, it really differs by state to state. Some states are okay with it. and some aren't. Obviously, same thing with foreclosures on the East Coast. You know, most lenders don't want to go down the foreclosure route. You know, they may start it, but sometimes it can take a year or several years, and they don't want to be in it that long. So I'd say, yeah, note sales are definitely a preferred option right now. If they can find a counterparty, that's a challenge in and of itself. And you know, Todd, you've obviously seen auctions be successful. I've seen a couple of those work as well, for the reasons you mentioned. But I think it is very different from the last cycle. And frankly, I think there's still a lot more to come. And so this could, you know, my answer would probably change a few months from now, as to what's more prominent. But as of now, it's less completion of foreclosures and more other workouts, and still a lot of, you know, extend and forbear. That's happening quite a bit right now.
So from our perspective, well, I'm looking at the 3 bullet points: foreclosures, note sales, auctions, receivership sales. So we're going to talk about that in a few minutes. We are seeing a tremendous amount, which we had not in the last cycle, as an example, Article 9 sales. And we are doing them constantly. And we're getting inquiries for Article 9 sales for all types of assets, be it real estate, C&I, just security interest. And we just did $110 or $20 million company Article 9 sale a couple of months ago. So it's all over the map. We've got a small one that just came to us for $2 million. So, you know, so we're seeing a lot of Article 9 sales, and that's a very, very fast process. Generally 3 to 4 weeks and it's done. Maybe 2 to 3 weeks, depending on the state and the type of marketing that we would be doing. Auctions are accomplished in a matter of 30 days, 45 days, so very quick. I think to Hemmel's point, receivership sales, which we're not receivers, but we work for receivers, and we are seeing in the Western states and in the East Coast a lot of receivership sales that we're handling, whether it's a brokered sale or an auction. Candidly, I love selling real estate through receivership. I think a receiver is highly underrated, unknown, or the assumption is a receiver's too expensive. I don't agree with that at all. And no, we're not receivers. We work for them. But the power the receiver has to go into court and take away a lis pendens, argue an escrow issue, that, you know, a buyer's not closing. They're just standing there with their hands in their pockets, trying to tie up a sale, and escrow can't do anything. So, you know, receiver marches into court, and we've seen it happen time and time again. And the judge says, sorry, you're done. And we move on to the next buyer. And so receivers are tremendously valuable. But yes, I think to your point, Hemel, state to state. And, you know, again, the asset type. But we are seeing more, I would say today we're seeing a little bit more, Selena, kind of to your point, we're seeing a little bit more creativity regarding the workout strategy than we did in, you know, I hate to say it, back in 08, 9, 10, where mostly were note sales. We were doing some auctions, a lot of note sales. We're doing some note sales, and we're actually even looking to acquire a portfolio of notes. Our capital group is currently right now. But I think my point is just it's a mixed bag.
And I should have noted when I said, you know, when we start the foreclosure, it gives them some time where the clock is ticking, but they're doing other things, the lender. One of the big things, not just note sales, we have a tremendous amount of files that a receivership has been put in place as another way of determining where they're going to go. I was thinking of my note sales because we just had a bunch of them go out the door, but really we have more. We have more than 50% of them that a receiver has been put in.
Fair enough. let's talk about new territory. Lenders need to be aware of collecting default interest and the ULA measure. Selena, you want to start with that?
Well, I just keep getting the questions of, you know, is it applicable? When am I going to have to pay that tax? And is it real? And it's real. And it is since I do the majority of our work at Beacon is commercial, it's a big number. And
Yes.
it really needs to be factored in. We take it back, part of that entire exit strategy that not everybody's keyed into. So it's a big deal. And the default interest, that's another big deal. We still see payoff letters coming in. We do take the time to look at the payoff letters to make sure that they make sense. And we're catching a lot of the default interest. We obviously are not attorneys and we're not giving legal advice, but we do suggest the client either relook at their numbers or consult with their counsel. So that is not charged. So we're really making sure we key in and pay attention to the payoffs we're given.
Okay, very good. Hemel, your thoughts?
Yeah, so just for those that are maybe unfamiliar or don't do a lot in California or LA in particular, I'll start with the default interest, and this is not uniquely California because there's some court cases that have come down in New York that also are kind of disfavoring default interest. Essentially, there was a court case that came out last year that was affirmed by the Supreme Court in California, or the appellate court, I should say, in California, that in which a lender was seeking to collect default interest on a unaccelerated loan in which the borrower had only missed 2 monthly payments. And the court struck down the collection of default interest, saying that it was not reasonably related, the amount of default interest is not reasonably related to the damages the lender actually suffered, which under traditional court cases has been what you call a penalty analysis. They hadn't traditionally applied that to default interest, but now they had. And so lenders have to closely look at the default interest they're charging and seeking to collect in a workout scenario to make sure that it, within the auspices of this case, they can distinguish themselves from that case, or if they fall within the purview of that case holding, how they want to proceed with the default interest. So that's the default interest. New York, like I said, has had some unfavorable cases, mostly in bankruptcy court, interpreting New York law that kind of come out the same way. So lenders, and I think the foreclosure companies do a good job of this. When you go to commence a foreclosure and fill out the paperwork, one of the questions they ask is, have you considered the implications of this case and how it impacts default interest? But it's something that should definitely be discussed with counsel prior to initiating a foreclosure or even seeking to collect default interest if it's in a litigation or otherwise. And then the other one, Measure ULA. This is distinctly Los Angeles based. A tax was voted in, I think it was it 2022? I think it was. Yeah, that essentially imposes a sliding scale of a tax. I think it's 4% for a purchase price of $5 million and up, and then from 10 million and up, I think it's 5% of the purchase price goes to the city. And it's a big number, like Selena said. And it does not, the most notably, the law does not distinguish between residential and commercial properties. It was passed as a mansion tax, quote unquote, and I think people were led to believe that it would only apply to residential sales, but there's no distinction, so it applies to all sales. There's been no court cases on it yet, unfortunately, that interpret it. And so one of the challenges we have as counsel advising banks and special servicers is, for example, on these large office buildings, we have a couple in downtown LA right now that are under receivership where we represent the servicer. And the servicer is saying, well, if we foreclose on this building, do we have to pay the Measure ULA tax?
Right.
And since there's been no court cases on it, our research indicates that yes, it would be due. So not only would the servicer foreclose on an asset that's declined probably 50–60% in value, they'd also have to pay, several $1 million to the city of LA for the pleasure of foreclosing on this office building. So it's a real challenge. It's something to consider in every Los Angeles-based real estate case at this point, that's even close to the $5 million threshold.
I'll just add, as on the brokerage side or the auction side for us, we're doing in LA County, that of course this ULA tax, the mansion tax, as you say, Hemel, is in force. We're analyzing that ULA cost, and as I mentioned before, the insurance issue as a front-loaded cost to sale, right when we're providing our opinions on where the property will trade for or / what we would list it for. So we make the sellers, whoever they are, very aware that there is these two issues, depending on where the property is, mind you. But the mansion tax is a big one, and we were just involved with a $50+ million sale of a residential property. And, there you go. You do the math. It was almost $3 million. And the seller pays it. The seller pays it. So you want to sell? That's what you're doing. I can tell you that on the I would say we feel it more on the residential side than the commercial side, that there are people that are not selling now because of the ULA tax. There is litigation pending that we're told about that, may make this tax. There's litigation against the city of LA, so nobody knows what's going to happen, whether it's going to stay in force or it's going to change in some way. But yes, the tax has to be collected at a sale now. But it is a major factor for sellers, and many do not think about it. So we look at the ULA and the insurance issue as a front-loaded cost at sale for a seller to determine. And going back to the appraisal side, as well, that must be noted in the appraisal, because it's not a hypothetical at all. Anyway.
Hemel, can I ask a question?
Please,
can I
go
ask
ahead.
For my own clarification, are you saying that when I foreclose an issue, let's assume it reverts back to the lender, and I am signing the trustee's deed upon sale, that ULA tax is applicable?
Based on what we've seen right now, and again, there's no court cases interpreting the measure, and there's nothing excluding foreclosures from a sale. Foreclosure is still considered a sale under Measure ULA. Based on that, the ULA tax would be applicable if it's over, $5 million.
Yeah. I can tell you from personal experience, our recordations, recorded deeds, are going through with no tax. I mean, I just did a trustee's deed on 246.2 million, and there was no tax, and I did about 4 last week. So I don't know if they can come back and retroactively go, hey, we shouldn't have recorded, because usually it's at that time that the transfer tax is paid. We're not seeing it on the foreclosures.
Interesting.
And that's, please don't anybody call me up and say, I am not an attorney. This is not, I'm just telling you what I personally have seen cross my desk. I make no representations.
Yeah, and again, it's a gray area for certain, because it's not clear in the statute. And so, perhaps their tax advisors and their legal advisors have advised them otherwise. And again, it's not legal advice for me either, but our research has indicated that it would be due on a foreclosure sale. But I don't think anybody knows until it's clarified one way or another.
Yeah.
So the question is there a clawback? Could that happen, Selena? I mean, yeah, I guess.
I don't know. I mean, obviously, if it was happening, I wouldn't be able to record these deeds, because we're not sitting on that type of money sitting in our trust account. The foreclosing entity, my special servicer or my bank, would have to send me money so that I could record their trustee's deed for them.
Well, I think I think that leads, there's a question that came up in the chat room, which I think we've kind of answered. But and now let's say the lender, the servicer, whoever, now goes to market and sells that asset.
Yes,
Right.
that I know. That is an absolute.
Right. So
That's an
then,
absolute.
then you've got, for sure, it's going to trigger it.
Yes.
Yeah.
Yes.
But to those who are listening carefully, if you're selling a note, we have not seen the tax be paid on a note sale.
And I don't think it's applicable to a note sale, Todd.
Yeah,
I
because
don't.
you're doing
Yeah,
an assignment.
It's
Yeah,
not a
there's-
real property. It's not a real property sale, right?
Right. So
Exactly.
there's a way to skirt paying the tax, meaning is a note sale more beneficial? It's an interesting, I guess, exercise in analysis. And I would say it would really depend on the asset, a note sale for the asset type, right? Is it more beneficial, or are you taking a bigger haircut selling using the note versus going fee simple and paying the tax? I mean,
Right.
in most cases, I would say to you, you want to sell the fee simple because the note sale might be 15, 20, 30, 40% of a haircut versus selling fee simple, right?
Right.
We're seeing that right now with a bunch of sales. A question from one of our viewers: is a deed in lieu exempt from ULA? Emil, I guess maybe that would apply to you.
As of now, just plain language of the statute, no, it's not. There's no exemptions for anything, any sales as of now. So it wouldn't be, a deed in lieu would still be considered a transfer of title and therefore a sale under Measure ULA. So I think the argument we made that it's due and payable.
Now, the one thing I think that just to happen to us on another deal, the lender, who's a private lender, I'll just cut to the chase. They wanted to sell the real estate that was held in an LLC and sell the LLC that owned the real estate, and the buyer would take over the LLC. Now, for those of you who don't know this, we are like the experts in selling partnership interests in real estate in the US. We have a specialized platform called Mimics, Minority Interest Market Exchange. And all that does is sell partnership interests that own real estate. Well, I thought this deal was going to get done that way, and I thought it was very smart. And then the buyer did some homework and found out that LLC had some past legal issues and decided that wasn't for them. But it is a solution to the problem, assuming the LLC is clean, and there could be certain indemnifications provided, right, Hemel?
Yeah.
By the seller, and the buyer would just take over the LLC, and that would skirt the ULA issue.
I think that's I haven't done an analysis of that, Todd. I think that sounds right. I mean, there is law out there and I think it's probably analogous with respect to property tax reassessments, that if less than 50% of the LLC is being sold, it does not trigger reassessment.
Correct.
So maybe that's it. Maybe that's how it would be looked at potentially. And I'm sure there's a lot of that going on. I mean, I know when Measure ULA first came out in the residential market, just reading the stories about how people were structuring, they'd sell a big house for 4.9 million, and then they'd sell the furniture for 2 million, right?
Correct.
To get around Measure ULA. And so I'm sure there's all kinds of things, creative ways people are trying to get around the tax. And I'm sure that continues to happen. And I don't know how rigorous the enforcement is at this point, because it hasn't been in place for that long. And like you said, it is under challenge. I think the lawsuit actually lost, Todd, a couple months ago.
Oh.
Yeah, but there is a proposition on the ballot in November this year to overturn it. And so people, there is still a great number of people that want to look to overturn it, and so we'll see what happens come November. But the litigation,
rightfully so.
Yeah. So
we just have a few. I got another question, but we just have a few minutes left. The last bullet point was really talking about Article 9 sales. I mean, I've mentioned it already. But those of you who are not familiar with Article 9 sales, it is again, a very simple, cost-effective approach, kind of along the lines of, Beacon Default and Selena. It's just a little different approach. But like I said at the beginning, we're inundated with doing Article 9 sales. The most common question we get and the most common issue we push back on is, it's your cheapest insurance policy to run the sale, but remember, it's got to be considered commercially reasonable. And every attorney and every lender and everybody we're talking to us is, what's considered commercially reasonable? And my answer is, it depends on the asset type, where it is, who's coming up against you. So how well do you need to protect yourself from a marketing standpoint? So the COIA is not just where and how you market the auction, but it's how long you market the auction. Our sweet spot is 3 to 4 weeks. That should answer your question there. But where and how we market the auction and advertise it and promote it, again, it's very tailored to the asset type. So, but it is a very simple, easy approach to using for a security interest to foreclose. One question we got from another viewer, real quick, we have a minute. Can a buyer choose to pay the ULA tax, thus reducing their basis in escrow in order to achieve a lower tax basis under Prop 13? That's an interesting question. I'll read it again, Hemel. Can a buyer choose to pay the ULA tax, thus reducing their basis in escrow in order to achieve a lower tax basis under Prop 13? Any thoughts, Hemel? Selena?
That's an interesting question. I'm just trying to understand it. So essentially paying the ULA tax that the seller would otherwise have to pay, but I don't see how that correlates to the property tax basis.
Right, because it's based on the purchase price.
Right. So I don't think
that doesn't, that's
I don't think it would work, because I think it's two different categories. You could certainly, the buyer could certainly pay the ULA tax that's subject to negotiation, but I don't think it would lower their property tax basis for Prop 13 purposes.
It's an interesting question. I don't have any answer regarding that question that was presented, but it did jog a memory that we did an auction, I think it was last year, where we forced through the terms of the auction process that the buyer pay the ULA tax through kind of the buyer's premium, which is standard and this was a real estate auction I'm speaking about. So that way, that buyer, the seller didn't pay the ULA tax, the buyer did. Now, did that benefit the seller on the sale of the property? I think that in that situation, I think it's probably 50-50, but it is an option to force to negotiate for the buyer to pay the ULA tax
and reduce the purchase price.
Correct.
Based on that pre-negotiation of that, so that your purchase and sale agreement matches up to
Correct.
where the meeting of the minds are, because that is what will govern or trigger your transfer tax with the recorder's office.
Correct.
And I see a clarification in the chat. He's saying to clarify an agreement for a lower purchase price between buyer and seller, which I think exactly what you're talking about.
Right.
So that could have a beneficial impact for the buyer. Right.
Well, look, we are now just a minute over the hour, and I can't believe how fast it went. And I have to thank Selena of Beacon Default and Hemel from Fransdell to participate and take their time and prepare for this presentation. I hope all of our viewers liked what we had to say. There will be another next month CMLA Zoom presentation. So look for that coming up towards the end of May. And I want to thank everybody. This presentation was recorded. It will be up on our website. So if anybody wants it, they can see it at their leisure. But Selena and Hemel, thank you so much. I cannot thank you enough for participating. And I'm really pleased with our conversation today. So thank you, and thank you, everybody. Have a good week, and be healthy and safe.
Thank you.
Thanks, everybody.
you
Thanks,
all.
Todd.
Thank you. Thank you all. Bye-bye.
Bye.